We're going to be dealing specifically with the reinforcing of fair value gaps, and it's a concept of trading inside the range. Okay, what is a fair value gap? It is a range in price delivery where one side of the market liquidity is offered and typically confirmed with a liquidity void on the lower time frame charts in the same range of price. Price can actually gap to create a literal vacuum of trading, thus posting an actual price gap. Okay, let's take a look at a euro-dollar daily chart. Okay, and I'm going to ask you, where do you see an example of the fair value gap? Okay, I'm going to draw your attention to it here. It's that blue shaded area here on the daily chart. Okay, let me explain to you why I'm shading in that specific area of price. It's about a 20 pip range on the daily. But inside of that blue shaded area, that is what is commonly referred to in my work as a fair value gap. So let's take a look at what makes that gap so significant. As you can see here, the candle to the left of the down candle we're looking at that comprises the fair value gap, that's this candle here. Okay, and to the left of that we have the higher bearish candle, and I'm drawing attention to the fact that it has a down close, but it's come off the low. Okay, so we're looking at the low up to the close, that little wick in there. If you take that same range, okay, and you look at our down candle that created that fair value gap on the daily chart, that range between 105.15 to approximately 105 big figure inside our down candle, and in this candle here that's highlighted from the low to the close, that price range has been traded up into once already, delivering the buy side liquidity. In other words, on this candle's low up to the close, price had come off that low. So if it came off that low to have a higher close on that candle, that means the buy side liquidity had been offered on that range between 105.15 to 105 big figure. So that means when we look at the down candle that makes the fair value gap, we're not concerned with the 105.15 to 105 big figure price range. So we're going to be drawing our attention to that low here, and we'll draw that out in time. But let's now look at the other candle that frames our fair value gap. The next area at which we see buy side liquidity offered is from this green candle or up close candle to the right of our down candle that makes the fair value gap. The open to the high on this candle has offered buy side liquidity as well. So we have seen price offered on the up movement or buy side liquidity on two candles, one to the left of our fair value gap creating down candle on the daily chart, and one candle to the right of it where we saw price move higher in portion of that down candle. So we have a range left that's open, and it specifically is this area right in here. So we're delineating the low of the previous candle and the high of the candle to the right of the down candle that creates that little pocket of space. So between 105 big figure down to 104.75, about 25 pips, that is our fair value gap, and it's been left open. There's been no trading outside of the movement of that range except for that down candle, and no up movement at all on this time frame. Now when we're looking at fair value gaps, okay, it's important to remind you that if we're studying a specific time frame, the gap occurs on the time frame you're looking at. You can break this down further into smaller time frames, but in the smaller time frames you'll probably end up seeing a liquidity void where the gap would be indicated here on this time frame. On a lower time frame, it would many times appear as a liquidity void, where it's multiple candles that create that open space of range. Okay, so now we have our daily chart here. We have our specific levels in mind that we're watching, and the two little line segments delineating one candle's low and one candle's high. In between those two reference points, we have that big down candle. In the exposed area in between, that is the fair value gap that only the sell side liquidity has been offered. So imagine that paintbrush analogy I've used many times in the past. On the down candle that creates the lowest low here, there's a range with the candle before it and the candle after it, where it has left a pocket of porous price action, or only delivered on the downside. We're going to expect price to eventually want to trade back up into that little gapped area. So this area in here, that's where we're looking to see it fill in. That's the nature of a fair value gap. So when we look at price, and we're zoomed in a little bit now here with a 4-hour chart, okay, and you can see that the two specific price levels again are delineated as well. And we have a low delineated for potential liquidity run on sell stops below the low. Price does in fact go down below that previous low. And now we can expect to see what form? A turtle soup, or a false break below an old low. Why would we reasonably expect it to go back up to fill in that gap? Well, because we've already taken the sell side liquidity out by running an old low. We have equal highs here delineated also on our chart on a 4-hour basis. And right above those equal highs, we have our fair value gap. Eventually, price does in fact trade back up, closes the fair value gap in. That trade or that idea is now complete. While it doesn't look like a great deal of money or pips offered, it's a very highly profitable and probable condition in the marketplace where we can see these fair value gaps and double tops where buy stops will be resting above it. And if you see a turtle soup run below an old low, you're in a range this time of the year going into the end of the 2006 trading year, going into the holidays. Trading is going to be range bound. And when you're in a range bound consolidation type format or profile for the marketplace, this is the style of trading you want to be doing, looking for stops and looking for fair value gaps. So it was well over 100 pips of a move, and it only took about 2 days to complete that little price swing. And in fact, this range of price action in the form of a fair value gap was actually detailed to you in the beginning of this week, where we delineated on the daily chart the fair value gap as outlined here. And on the daily chart, you can see it's been filled in here. So while there's a lot of information about fair value gaps and breakaway gaps and measuring gaps that's going to be coming your way in the form of the December study notes, just understand that everything that's been shown here is reversed for buy side liquidity runs, where the market will come back and close in a fair value gap that's below the marketplace to seek to fill in the sell side liquidity. I want to take a quick look at something else, because I mentioned that the gaps, fair value gaps, liquidity voids, order blocks, and liquidity pools, they kind of overlap in a lot of different ways that you're probably not aware of yet. And that's what the benefit of having the PDF files, study notes, and also the supplementary teachings that's going to happen next week, Monday through Friday. While we're away from live trading and live sessions with the ICT mentorship, you will be getting a daily video supplementing these specific techniques and concepts for the month of December. So it'll help you really dial in on the concepts going forward, so that way you're prepared and primed for the content for January 2017. But I want to take you back over to the charts, and I'm going to give you something by way of understanding the overlap of liquidity voids and fair value gaps. Okay, folks, we're looking at that 104.75 level. I have the charts trained in on a 5-minute euro dollar, and we're seeing the very moment that that 104.75 level was pierced here on the 19th. This is the second time it trades through that 104.75 level. And I want to just draw a special attention to this area up here. Okay. And now I'm going to show you what it looks like when we have a run above an old high, which is what this is, 104.75. It's also run on liquidity in the form of a liquidity pool, so it's running buy stops, but also it's hitting that fair value gap also. So it's trading into the fair value gap, and I said on the lower time frames, many times this will create a liquidity void. You see a movement lower here on this candle, and then we have another candle here. Look what happened. The next candle's open is down here. So you have this gap in here. So price trades up into that and closes that in right there. See that? Price then moves lower. Significant break lower. And then lower. And then ultimately trading through to where the sell stops were mentioned earlier. Okay, let's take a look at it on a 15-minute basis. Here's the first time it trades up into that 104.75 level, closing that fair value gap. And then here's the second time it trades up into it, running out the previous high. The previous high this time was at 104.77. This candle's high comes in at 104.78. So it trades to it and just by 1 pip. Now watch the difference here. We have a down candle here, a lot of movement lower, but it comes off that low. Watch what happens now. We gap from this candle's close, 104.72, to an opening on this candle of 104.70. Now it's only 2 pips difference, but that creates a what? A gap. So we can be a seller at a more refined price level. Mentioned in an earlier time, we said that we could be a seller at 104.70 on a limit. When price trades back up to that level, if it doesn't give us an opportunity to go on a limit, we can trade it right as it hits it live. If you can be in front of the charts, right there. There's your sell. Now here's the thing. Look at the body's close on this candle right here. The close is 104.72. That's exactly the high on this candle's close, 104.72. The wick trades through the body, but the bodies of the candle completely close in here. So this gap between these two candles, these two black down candles, this gap in between the bodies have perfectly been filled in with this up candle. So this is exactly what I'm referring to as efficiency in terms of the price delivery. If this movement lower has been offered on the downside, okay, now think, look closely. This candle's high comes in at 104.78. The close is at 104.75. The next candle, it opens at 104.76. I'm sorry, 104.74, and then it creates a high at 104.76. So it moves 2 pips up. So from the opening to the high is buy side liquidity offered. Then it trades down for a down close. Then we gap down here. There's a gap of buy side liquidity from these two candles from this candle's opening. That's exactly where this price goes on the upside from the open to the high. The open is 104.63. The high is 104.74, which is the opening here. 104.74. That's the last point at which the buy side liquidity is offered on the up movement. Then it's all down from the opening. It fills in that perfect delivery of price right there. And then at that moment, when you see this live, you can be a seller at that moment. And price does exactly what we mentioned earlier when we were looking at the higher time frame. This delivery here, price from this candle's low up to the close, buy side was offered here, and buy side was offered from the opening to the high here. So there's a gap closure here on all of the downside movement here. So this has all been closed in. So efficiently, we could look for this range being delivered lower. We have to consider back here where price was delivered on the buy side here. So this low comes in at 104.55. So if we drop that down to there, 104.55, that's where the last point at which the low had traded up to the close. So buy side liquidity has been delivered. Here, it's all sell side liquidity. At this moment here, it's all sell side now. Nothing over here until we get over here. So we created a gap down here. Price trades up, hits it here, hits it here. We could be a seller at 104.55 or 104.50, looking for a move down below 104.15 to 104.10. And there's your run right there. Perfect delivery at price. Hits it here, hits it here. Look at the high on that candle. 104.55. 104.55. The low on this candle, 104.55. The buy side, all green candles up, then it comes down. So this is all efficiently traded. It's a full block of delivered efficiency. Up and down, both ranges on both sides of the delivery of price. The buy and the sell side have been offered in here, from this low to this high. Once we break this low here, we're all on sell side now. It comes right back to it here. Perfect delivery, efficiently priced at 104.55. Does it twice. Time to sell it off and wait for it to run the sell stops below this low and this low down here. Let's just put a line on it so you can see. Right there. And watch the delivery. Boom. Perfect. So perfectly delivered down into the sell stops below the low lows. So hopefully this has been a little bit more insights into how the liquidity pools and liquidity voids and fair value gaps draw together in an overlapping scenario. But again, there'll be a lot more scenarios to outline in your PDF file for December's content. So I wish you good luck and good trading.